As you know, I've failed retirement completely, and the consequence is that I still have income that's beyond my needs, and I save the delta between what I earn and what I spend, and I save it in gold. The consequence of that is that it's an item I want to buy. And if there's an item you want to buy, you don't want to see it increase in price. Of course, it makes me feel nominally better that the purchasing power of the gold that I have in my portfolio increases. But the truth is, from here, it would require substantially higher gold prices to get me to sell. And I'm content to buy at current levels. So my own interest is served by lower rather than higher gold prices. It's important when you put that statement in context that I'm expecting that the gold price, at least in nominal terms, in US dollar quoted terms, does very well in the next 10 years, but maybe not in the next 10 weeks. It wouldn't surprise me to see higher US interest rates keep gold soft or even cause it to decline for the balance of 2026. Looking longer, all of the earlier conversations that you and I have had in these interviews about the fact that I believe as a consequence of debt and deficits that the purchasing power of the US dollar declines substantially over 10 years means I'm extremely confident in the long-term outlook for gold. And for me personally, despite the fact that I'm 73 years of age, the near-term price of gold is of no concern to me. In my experience, precious metals bull markets are led by gold. They're led by the fear buyer. When the increase in the gold price makes the precious metals narrative of interest to the generalist investor, and the generalist investor comes into our little precious metals ghetto, the lower unit price of silver usually causes the generalist investor to concentrate his or her purchases in silver rather than gold, and silver then begins to outpace gold. This traditionally has taken place fairly late in both secular and cyclical precious metals markets. Principal fundamentals for me are three. One you touched on. People aren't talking about it. And I like assets out of the mainstream. But there are two more. The first is that platinum and palladium are critical components in autocatalysts. The big thinkers in the world have suggested that we'll use less autocatalysts in the future because they believe the internal combustion engine is going the way of the dodo. I think that's wrong. I think we'll continue to require autocatalysts for cars and for all matter of energy generation from fossil fuels. But supply is also an issue. Most PGMs in the world are produced in three countries: South Africa, Zimbabwe, and Russia. And the potential for supply disruptions, social chaos in all three of those countries, I would suggest to you is relatively high. I'm not saying we're going to see a breakdown in any of those three countries, but should we do so, the demand for platinum would continue unabated, but the supply would decline dramatically, leaving in place the possibility, not the probability, of very rapid price increases.
His confidence in gold isn't built on tomorrow's headlines. It's built around the next decade. He expects higher U.S. interest rates could keep gold soft, maybe even push it lower through the rest of 2026. But zoom out and the picture shifts. Mounting government debt and deficits, he argues, will steadily erode the dollar's purchasing power over the next 10 years. That's the long-run thesis that keeps him unbothered by short-term dips, a distinction he thinks a lot of retail investors struggle with, mistaking near-term volatility for a verdict on a strategy that's playing out over a completely different time frame.
Now, for those people who listen to you, who have the ability to add value in real estate, for those people who have the ability to buy a building that isn't living up to its potential and fix it themselves, there's no better asset class on the planet. I don't happen to be one of those. Warren Buffett once said he, as he became older, became more attracted to investments that required of him sloth and lethargy. And I agree with that assessment. Depends on how hard you're willing to work, how much volatility you're willing to stomach, and frankly, how greedy you are. an argument could be made for many of your listeners who have lives. They have jobs, they want to play with their kids, they want to read books, they want to play golf. Those people should be content with market beta. Beta defined as the delta between the increase in price exhibited by the gold sector and the increase in price exhibited by the broad market. For many investors who I talk about who like the gold thesis but can't stand the volatility, don't want risk, and don't want to do the work, importantly, they should construct a portfolio of Franco-Nevada, Wheaton Precious, and Agnico and go golfing or go fishing or do something they want to do. For others of your listeners who find the game interesting and who are willing to do the work, they should be looking for takeover targets. They should be studying the precious metals market as an opportunity. Understand that you do so at a cost. This takes away from other aspects of your life. When people ask me how I can afford to own so many mining stocks, it's because I pay a team to help me study them. And I forego other aspects of my life. Today is a beautiful day in the Pacific Northwest. I mean, just spectacularly sunny. And it's crab season. Now, one thing I could do is take my little rowboat out into Puget Sound 4 or 5 times today and harvest crab, an activity that I dearly, dearly, dearly love, and an activity that's very good for me as a 73-year-old, rowing my boat out, pulling up crab pots, doing stuff like that. Instead, I'm studying mining stocks. So that comes at a cost. Now, I happen to enjoy studying mining stocks too, but many of your listeners wouldn't. Many of your listeners would probably be better served buying the highest quality companies and taking their children or their grandchildren out catching crab or catching salmon. It's a lifestyle choice. It depends on your time frame. I think there's 100% certainty in the 5 to 6 year time frame that a carefully chosen portfolio of higher quality silver stocks will do extremely well. I think, and my former partner Eric Sprott has proven it, there's even more money to be made if you can stomach the risk and the volatility in low-quality silver stocks. Paradoxically, the low-quality ones do better in a bull market than the high-quality ones because they get better margin expansion. Most people can't stomach the risk and the volatility to participate in the crummy silver stocks. I can't do it because it's inelegant. These are businesses that are usually selling relative to the quality of their earnings at premiums to companies that seem more expensive, but they certainly offer more leverage. And for some silver speculators, Eric Sprott, particularly among them, perhaps the most successful of that ilk, leverage to the silver price is the key speculative attribute that they look for. I'm not one of those. I'm more drawn to quality.
Precious metals bull markets, by his account, tend to follow a fairly predictable script. Gold moves first, driven by investors seeking safety. Only later, once gold's rally becomes mainstream news, do everyday investors start piling in. And because silver trades at a much lower price per ounce, that wave of new money tends to flow into silver instead, pushing it to outpace gold. This rotation typically shows up late in a cycle, not early. It's less a prediction and more a pattern he's watched repeat over decades, as capital chases the cheaper, flashier metal once the broader public finally catches on that the trend is real.
I'm a basically happy person, and with the exception of government and taxes, I try to be cheerful about everything. Absolutely. I mean, I believe that money is made on the delta between price and value. In bull markets, value gets more expensive, which is bad. In bear markets, value gets cheap, which is good. It's interesting that people, when they buy consumer goods, often do well. There will be consumers that will spend 15 hours buying a car, or 4 hours buying a coat, or will spend 10 minutes in a grocery store looking at the calorie count or the expiration date on groceries. But when it comes to stock, it's got a hunch bet a bunch. That makes no sense. Many people, if there's a stock that goes from $2 to $4 with nothing changing, get excited by the price momentum. If they went to the store and they bought a can of tuna fish for $2 and 2 weeks later it was at $4, they'd be outraged. The truth is, if people bought stocks the way they buy tuna fish, more people would make more money. I don't view them for the next 6 or 12 months. I think you need to have some sense of what's going to happen in the Gulf, and I have no sense whatsoever that, in terms of what's going to happen in the Gulf. And looking a little bit longer term, you need to decide if the current state of affairs between Russia and the Ukraine stays the same. To the extent that saner heads prevailed and we had peace in the Gulf and we had peace in Eastern Europe, I think that we'd see a period of lower risk premiums in the oil business. Looking longer term, not much longer term, 2029, 2030, I think that the high oil prices that we've seen as a consequence of artificial shortages, which is to say, a hiatus in some Russian oil and gas shipments, and then a hiatus of shipments through the Persian Gulf, are portents of what happens when the shortages become structural. People who want to invest in oil really need to focus less on the Straits of Hormuz and more on the fact that the oil industry has been underinvesting in sustaining capital to the tune of over $1 billion a day. The shortages of oil and gas that we're experiencing now are really temporary and could be solved with an armistice. I'm not saying that we're going to have an armistice. I'm just saying that they could be solved with an armistice. The problems that we're going to have in 2030 are a consequence of underinvestment. And that can only be solved by the application of massive amounts of capital over time. But the important lesson is the price elasticity and the near-term demand inelasticity around oil in the face of shortages. When oil comes to be rationed by price, it will be a good time, I think, to be an oil investor. People need to understand, however, that when you reset the oil prices higher in real terms, not in nominal terms, but in real terms, the governments around the world will come to steal a greater and greater and greater amount of free cash flow. You need to understand that. And it won't occur just in places where you think the governments are usual suspects. I myself remember in the USA, the last period of higher oil prices we had were accompanied by an excess profits tax. You didn't see an excess profits tax in the motion picture business. You didn't see it in consumer products. You saw it in the oil business. And that, I think, is something that you'll see replayed in 2031, 2032, 2033. I think the structural shortages will be accompanied by a greater degree of government theft.
Beyond gold and silver, he points to platinum and palladium, metals critical to auto catalysts and industrial emissions control. Predictions of the internal combustion engine's demise, he argues, are overstated, and demand for these metals will likely stick around far longer than most assume. The bigger risk, in his view, is on the supply side. The vast majority of global platinum group output comes from just 3 countries: South Africa, Zimbabwe, and Russia, each carrying real potential for political or social disruption. A supply shock in any one of them, paired with steady demand, could send prices sharply higher with little warning.
It depends on who you are. I can afford to be opportunistic now because I've been a fairly consistent buyer of energy stocks for the last 3 years. So I don't need to go establish a position in Exxon. I've done that. I don't need to establish a position in Freehold Royalty or International Petroleum. I don't need to establish positions in either investment quality or speculative grade oil stocks. I can afford to be opportunistic. But most of the market, probably including most of your listeners, are underinvested, or many of them uninvested. And those people need to consider averaging into the sector, because over the next 5 years it will do very well. Asking, or which you didn't do, but applying the same logic to the precious metal sector, it astonishes me that precious metals, either physical or stocks, or the precious metal sector comprises less than 0.5% of the total savings and assets of Americans. That's down from a 4-decade mean of 2%. What that means is perhaps not in your audience, but looking at investors and savers as a class, they are stupidly uninvested in gold and silver. I mean, really, truly stupidly uninvested. If we merely had a reversion to mean, which is to say the market share of precious metals relative to other savings and investments in the United States, reverted to mean, you see a 4-fold increase in demand. And I think that's precisely what we're going to see. The idea that people wouldn't want to position themselves and get in the way of that flow of funds astonishes me. It delights me too. I'm 73 years of age, so I'm older and slower moving. That means that my competitors are giving me more time to get positioned. I joke with longtime listeners that even an old, fat, bald 73-year-old like me can win the 100-meter dash if I'm the only guy that shows up to run. And that's what I feel like in the gold market sometimes. Again, it depends on who you are. I mean, the easy money's been made, Vlad. When you and I started interviewing, the uranium price was $20 a pound. And it was hated. I mean, if you looked in the social media comments around uranium, if there were 20 comments, 18 were opposed, and some of them were violently opposed. It doesn't get better than that. So it's clear that the easy money has been made. But I think the sure money is ahead of us. The difficulty, again, and you'll hear this theme again and again and again in this interview, is the fact that many of your listeners have time preference, and the markets don't care about their time preference. Many investors understand or can be made to understand the strategy, the rationale behind uranium. But if you're talking about a market trend that takes 3 years or 4 years or 5 years to play out, and your tactics are that you have trauma holding stock over a long weekend, the delta between your strategy and your tactic means that you're never going to make any money.